All right, let's get right into it. Welcome to this explainer, where we're unpacking a truly massive shift in the digital frontier. For a solid decade, cryptocurrency has basically operated in this crazy legal gray zone. Depending on exactly where you were in the world, you might get sued, you might get a regulatory sandbox to play in, or your project might just get outright banned. Nobody had actually written a comprehensive rulebook for this space. Well, until Europe stepped up. Today, we are diving deep into MiCA, which stands for the Markets in Crypto Assets Regulation. It's this highly anticipated 200-page beast of a law that effectively takes the chaotic Wild West of crypto and forces it into becoming a heavily structured, licensed financial sector.
And to really understand why this is happening now, you just have to look at the sheer scale of this number. $48 billion. Let that sink in for a second. That represents the combined, absolutely staggering losses from the collapses of Terra and FTX back in 2022. We all know this wasn't just some standard market dip, it was a total financial catastrophe that completely wiped out the savings of millions of everyday retail users, and a huge chunk of them were right there in the European Union. So, this massive $48 billion black hole, it served as the ultimate catalyst. It was the exact moment politicians just stopped debating and started demanding immediate, super strict rules for the entire crypto industry.
So how are we going to make sense of this massive 200-page document today? Here's our roadmap. First, we'll look at the end of crypto chaos. Then we'll decode who and what is actually covered under the law. After that, we'll tackle the incredibly strict new stablecoin rules, explore the gray areas surrounding DeFi and NFTs, and finally, wrap up with the Brussels effect. Basically, how this European law is going to completely reshape the platforms you use, no matter where you live in the world.
Okay, part one, the end of crypto chaos. Let's look at how we went from a totally fragmented regulatory nightmare to one unified law.
Now, the absolute crucial point here is understanding what the pre-2024 landscape looked like. Before MiCA, crypto companies were essentially playing this massive, chaotic game of regulatory whack-a-mole. Every single EU country had its own totally different rules. You had Germany with incredibly hard, strict licensing requirements. And then you had places like Malta, running around branding itself as Blockchain Island, with very loose rules. So companies would naturally just forum shop for the easiest jurisdiction. But MiCA changes all of that entirely. Now, there's just one unified framework. If you comply with MiCA, you get this single, structured passport. And that passport allows you to serve all 27 EU nations and 450 million people. Boom! The whole forum shopping era ends overnight.
And honestly, it is kind of wild to see how fast governments can actually move when they're properly motivated. Check this out. The MiCA draft was actually proposed way back in September 2020, but it kind of just stalled out in the bureaucracy. Then, November 2022 hits, Terra and FTX collapse, suddenly the EU Parliament adopts this rigid, never-again mentality and just fast-tracks the whole thing. By June 2023, the law is officially published. Fast forward to mid-2024, the stablecoin rules went live, and by the end of 2024, the full weight of the rules for service providers snaps completely into effect. Which brings us to the core philosophy driving this entire 200-page document: same risk, same rules. This is absolutely crucial to understand. The European Union completely rejected the industry's favorite excuse, the idea that blockchain technology is somehow exceptional and therefore deserves special, lighter rules. Nope. The EU's stance is blunt. If your crypto exchange functions like a stock exchange, guess what? It must be regulated like one. If your stablecoin acts like a bank deposit, it needs the reserves and audits of a real bank. No exceptions whatsoever.
All right, let's move into part two, who and what is covered. Time to decode some of the heavy legal jargon and figure out exactly who has to comply here. So get really used to this acronym, CASP. It stands for Crypto Asset Service Provider. These are basically the gatekeepers of the industry. If you run an exchange where crypto is traded for fiat, or if you hold custody of client funds, congratulations, you are a CASP. And under MiCA, you now need a seriously rigorous license to operate. And getting this license? Yeah, it's no joke. It takes months, requires a strict minimum of 150,000 euros in upfront capital, and can easily cost millions in legal and compliance fees. But remember that trade-off we talked about. Once you have it, you hold the golden ticket to serve the entire European Union. Now, what about the tokens themselves? How does the law treat those? Well, MiCA essentially divides the entire crypto universe into three specific buckets. First up, you've got EMTs, or e-money tokens. Think of these as your standard stablecoins pegged to a single fiat currency, like USDC. Second are ARTs, or Asset Reference Tokens. These are pegged to a basket of different assets, kind of like the old Facebook DM project, if you remember that. Finally, there's the giant Other category. This is your Bitcoin, your Ethereum, and all your standard utility or governance tokens. As you'll see, MiCA treats stablecoins vastly differently than it treats regular crypto.
But wait, what if you actually want to issue a brand new token in that Other category? Well, the era of the anonymous, two-page ICO launched from a basement is officially dead. MiCA introduces these incredibly strict, almost IPO-like requirements for token issuers. You now have to publish a highly detailed 50-plus page white paper spelling out your tech, your team, and your tokenomics. It's literally a lawyer's dream and a crypto founder's worst nightmare. You gotta submit it 20 days before launch. And here's the real kicker. The CEO actually has to sign off on it, assuming personal legal liability. Meaning, if there are false claims in that white paper, the founders can face massive fines or even real jail time.
Okay, part 3, the strict stablecoin rules. Because honestly, this is where MiCA really shows its teeth, and it's born directly from the trauma of the Terra collapse.
Like we talked about, the EU watched $40 billion just evaporate in the Terra death spiral, and their response was absolutely uncompromising. Algorithmic stablecoins, they are completely banned in the EU. Just flat out banned, period. If you want to issue a stablecoin now, it must be backed one-to-one by actual low-risk segregated fiat reserves. It has to be constantly audited, and users must be able to redeem their tokens at par value in exactly 1 day with zero gating or delays.
But MiCA goes even further, and this specific number is making massive waves globally right now. 200 million euros. That is a strict daily transaction cap placed on non-EU stablecoins. Meaning if a dollar-pegged stablecoin, like Tether's USDT, exceeds 200 million euros in daily transactions within the EU, they legally have to stop issuing new tokens. This is a direct, targeted threat to dollar dominance in the crypto market. It's entirely designed to force these massive companies to launch fully compliant euro-backed versions of their stables if they want to keep doing business in Europe.
Oh, and there's another fascinating little caveat buried in the fine print. Crypto stablecoins, those e-money tokens we talked about earlier, are strictly prohibited from offering interest or yield to the people holding them. Because if they do, regulators say they cross the line into becoming unregistered bank deposits. So what does this mean in practice? It means traditional fiat banks get to keep a major competitive advantage. Banks can offer you yield on your deposits, crypto companies issuing stablecoins absolutely cannot.
Moving on to part 4, the gray areas. Because, despite being 200 pages long, MiCA isn't perfect. Let's look at what slipped through the cracks and currently sits in a very risky legal gray zone. So the two big gaps are decentralized finance, DeFi, and NFTs. The text officially says that if a protocol is fully decentralized with no intermediary, it is completely exempt from MiCA. But what does that actually mean in the real world? If there's a registered company running the front-end website or a DAO multisig where just a handful of people hold the administrative keys, regulators are very likely to classify them as a regulated CASP. As for NFTs, truly unique one-of-one art pieces are exempt. But if you take an NFT and fractionalize it into 100 pieces for trading, yep, you just stepped right back into MiCA's regulatory crosshairs. Finally, part 5, going global. Now, you might be sitting outside the EU right now, listening to this and thinking, okay, interesting, but why should I care? Well, here is exactly why you need to care. It all comes down to a phenomenon called the Brussels effect. We actually saw this happen a few years ago with GDPR and internet privacy. When Europe sets a massive, unified standard like this, global companies quickly realize it's actually way cheaper and easier to just adopt that European standard worldwide, rather than trying to maintain 20 completely different sets of rules for different regions. And we're already seeing it. Major players like Circle and Binance are actively standardizing their global operations right now to comply with Europe's MiCA baseline. So, what is the actionable playbook for actually surviving this new era of digital finance? Well, if you're a centralized exchange, you got to spend the time and the millions of dollars to get that CASP license. If you're issuing a token, grab a coffee and get ready to pay the lawyers for a 50-plus page white paper. If you're building in DeFi, you have to completely avoid having an EU corporate entity or a centralized front end, or you risk some huge fines. And for the everyday user, you're going to be using highly licensed, KYC-compliant on-ramps to get your money in and out of the ecosystem. The Wild West is truly over. This new era is licensed, disclosed, and highly bank-like. Which leaves us with one final, absolutely crucial question to ponder. Is your crypto ready for the Brussels effect?
Because whether you trade in Paris, New York, or Tokyo, these overarching European rules are inevitably going to alter the platforms, the tokens, and the stablecoins you interact with every single day. The regulatory certainty we've all been asking for is finally here, but the cost of innovation just went way, way up. Thanks so much for joining us on this explainer, and we will see you next time.